Hello and good day, everyone. We are pleased to welcome Nilanjan Paul, Partner in Audit and Assurance, MSKC and Associates LLP, who will help us navigate the regulatory landscape by covering the recent updates during the past quarter, including some of the critical NAFRA updates and key amendments to the SEBI listing regulations. In today's session of Insync with BDO India, thank you for joining us, Nilanjan. Over to you.
Greetings, everyone, and I welcome you to this episode of Insync with BDO India, where we talk about navigating the regulatory landscape relating to developments which have happened in the previous quarter. We have two major developments that we wanted to cover NFRA updates and a plethora of developments which SEBI has instituted in the past quarter. Regarding the NFRA developments, the NFRA has issued its inaugural series about enhancing the quality of interactions between auditors and audit committee. In this series, they have covered the interactions between auditors and audit committees regarding a very significant estimate and judgment area, which is the expected credit loss. Now, this particular series do not clarify or provide new accounting or auditing requirements, but they are uh, a, a list of gating questions which are illustrative. It also provides an opportunity for the audit committee and auditors to enhance their interactions. Uh, if you would look at this slide, a thematic review of these questions could be regarding validation of ECL model, robustness of internal controls, special attention on related party balances, and management experts' independence and judgment. It is expected, uh, considering uh, the upcoming result season, it is expected that the audit committee engages with the auditors in a much more detailed way. So we would suggest that these questions are actually considered by the auditors in their audit strategy so that they can they can effectively respond to the questions, if any, of the audit committee on these topics. Moving to the next slide, uh, in the last quarter, NFRA issued a circular clarifying the auditor's uh, responsibility as far as the group audits are concerned. Now, the background to this circular is that the existing auditing standard on using the work of another auditor had remained unchanged for a very long time. Coupled with the fact that there had been wide-scale corporate failures and significant international developments, NFRA felt that the time is opportune to seek global alignment. So in the October of this year, NFR issued a circular which which provided its interpretation of the existing auditing standard on group audits. What we would like to highlight that the NFRA circular is only an interpretation. It doesn't modify the existing auditing standard. So in a nutshell, the NFRA circular talked about three or four key things. First, the principal auditor continues to remain responsible solely for the overall group opinion. The principal auditor should assess the sufficiency and appropriateness of procedures just performed so as to enable them a group-wide audit opinion. The principal auditor should also assess the competence and capability of the other auditor. There were also concerns regarding sharing of work papers and restrictions on review performed by the principal auditor. The NFRA has very clearly clarified that uh, the existing Companies Act 2013 as well as the auditing standard do not prohibit the principal auditor from either reviewing the work of the component auditor or asking for a copy of the work papers. But why is it relevant for board and audit committees? So we have tried to put down our key highlights, why we believe that a change from an auditing side will have a ripple effect on the board and audit committees as well. So from a those charged with governance perspective, we would like to highlight that under the Companies Act 2013, the responsibility of the financial statement lies with the management and board of directors of the holding company. Also, under the Companies Act 2013, the uh, the board and those charged with governance must ensure that the auditors have unrestricted access to any information or any person within the group. Also, they are responsible for overseeing the financial process. If there are any restrictions or limitations that the principal auditor uh, envisages or experiences, it is the responsibility of the board and those charged with governance to mitigate those concerns. As far as the group management is concerned, they are required to prepare the financial statements as per the applicable laws and regulation and accounting requirements. They are also required to send group accounting manual specifying the information to be required. They are also required to establish appropriate internal controls for us to have an error-free financial statements. They are also required to ensure that they provide unrestricted access to relevant person and information. As far as the component management is concerned, they are mandated to prepare the component financial information with the group accounting manual. Similarly, they should provide an access to the principal auditor and other auditor to all relevant information regarding the audit of components. So you would appreciate that even though the circular is from an auditing standpoint, but since considering the close interaction between auditors and audit committee, it is important that we pass on these information to the board and audit committees in our interactions for a seamless audit experience. What we also expect that because of these clarification, the existing milestones for completion of audits might require reassessment by the board or by the audit committee. We also expect the principal auditor to put additional efforts and resources for these audit at a group level. Accordingly, it is important to have an early engagement with the auditors for for seamless completion and execution of audits. We'll now move to the key amendments to SEBI listing regulations. Uh, in uh, in the last month, which is December 24, SEBI issued a host of amendments to the listing regulation. Largely, these updates or amendments are effective from 12th December 2024. SEBI has also issued a circular to operationalize these amendments. Largely, if I have to tell you, these amendments and updates are aimed at ease of doing business and also to achieve regulatory alignment. Related party transactions and secretarial audit, which is a key element of corporate governance, continues to be an area of focus. We would advise the board and audit committees to revisit their existing policies so they remain compliant with the requirements of SEBI listing regulation as amended. If I have to talk about the first one on related party transactions, there had been certain relaxations from the definition of related party as well as from the approval mechanism. Uh, to, on your left, if you would see the carve outs from the definition of related party transactions, they have clarified that any transaction which is carried out with public at terms and conditions which are available to public at large and which do not establish uniform which do not establish a business relationship will not fall within the ambit of a related party transactions. Similarly, if there are certain corporate actions by the listed entity or by its subsidiaries, for example, a dividend or a buyback, they're also outside the ambit of related party transactions. If a bank is accepting deposits based on uh, the uh, R- the definitions of RBI or other jurisdictional norms, they also are not considered to be a part of related party transactions. Moving on to post facto ratification, the SEBI LODR has expressly provided for post facto ratifications, and obviously they have provided certain safeguards. So an audit committee can ratify related party transactions within 3 months or within the next meeting, whichever is earlier, if the value of those related party transactions is less than INR 1 crore. The transaction is below the materiality thresholds as prescribed under SEBI listing regulations. The rationale is disclosed to the audit committee and the details are also disclosed to the stock exchange. We'd like to highlight that similar ratification norms were also prescribed under the Companies Act 2013, but with these introduction of safeguards, there would be a much more discipline in the approval of related party transactions. Uh, the SEBI had also provided relaxations from approval of audit committee. So, if remuneration and sitting fee are paid to certain directors, KMP, or senior management personnel who are not part of promoter or promoter group, and the amounts are below the materiality thresholds as prescribed by SEBI, then they are outside the ambit of audit committee approval. Similarly, the omnibus approval mechanism has been extended from the holding company to also cover related party transactions of the subsidiaries. From a financial reporting standpoint, what we felt important is that the advertisement of financial results in the newspaper has been further eased. Now, instead of publishing a complete financial results, you can publish a QR code, which will ultimately link to the complete set of financial results. Again, a relaxation. Uh, Regarding approval of quarterly financial results of entities having non-convertible securities, earlier these financial results were only required to be noted by the board of directors. Now they are required to be specifically approved by the board of directors. Similarly, the person who are permitted to sign the financial results have been extended. Earlier, they were limited to managing director and executive director. Now, these financial results can be signed by the chairperson, managing director, or whole-time director. Or if none of them are available, the signing can be carried out by any person delegated or authorized to do this activity. Regarding the constitution of board and its committees, few clarifications and few amendments. As far as the meeting of board of directors is concerned, it has been clarified that the meeting has to be ensured, the minimum number of meetings has to be ensured on a financial year basis. And also it has to be ensured that the maximum gap between two consecutive meeting is within the prescribed limit. Regarding filling of vacancy by the committee of board, SEBI has amended to clarify that if the vacancy of the director affects the composition of either the audit committee, the nomination and remuneration committee, stakeholders committee, or risk management committee, in such case, the vacancy has to be filled within a maximum period of 3 months. Regarding appointment of non-executive directors, they have clarified the point in time when the special resolution is required to be obtained for appointment of non-executive directors who has aged 75 years or above. SEBI has updated the requirement to state that the special resolution for appointing or reappointing a non-executive director aged 75 years or above must now be obtained prior to the director attaining 75 years of age. SEBI has also prescribed relaxations from shareholders' approval in certain cases. So, for example, where a sale, disposal, or lease of assets between two wholly owned subsidiaries is expected, in that case, the shareholders' approval is no longer required. Similarly, the time limit for obtaining shareholders' approval uh, for a person should exclude the time that is to be taken from a regulatory authority. In a nutshell, what I would like to emphasize is that the the outlook of of SEBI is moving from a legal entity perspective to a more group level uh, perspective. So, if you would look at the shareholders approval, relaxation from shareholders approval, they are trying to move beyond legal boundaries and to ease the regulatory compliance, which may not be relevant at a group level. Secretarial auditors. On a high level basis, the norms for secretarial auditors appointment are very similar to appointment norms as prescribed under the Companies Act 2013. If you would see on the left hand side, the tenure of a secretarial auditor is, if it is a firm, then it is a 2 terms of 5 consecutive years. They have to mandatorily being peer reviewed, and the disqualification criterias for a secretarial auditor is also aligned with the requirements of Companies Act 2013. But there are certain provisions which are not aligned, but I would believe that they are primarily to do with differences uh, in the type of professions. For example, under the Companies Act 2013, an auditor cannot perform bookkeeping services or actuarial services because they are prohibited, whereas under the SEBI LODR, a secretarial auditor can perform or can provide accounting, bookkeeping, or actuarial services. Regarding the fulfilling of vacancy, the casual vacancy has to be filled by the board within 3 months, whereas under the Companies Act, it has to be filled within 30 days. Regarding providing non-audit services, the secretarial auditor has to obtain the approval from the audit committee for providing any non-audit services. Regarding the statutory auditor, this requirement of non-audit services, the approval of which should be obtained from the board of directors. Uh, Moving on to BRSR core, SEBI has established the Industry Standards Forum for much more engaging relationship with the stakeholders and corporates at large. So one of the guidance which the Industry Standards Forum has issued last quarter is relating to the preparation of BRSR core. We know that BRSR and BRSR core is required to be presented by certain class of listed entities. If I have to talk about the theme, the Industry Standards Forum facilitates the ease of compliance and clarifies businesses on how to report on BRSR core matrices. So thematically, if I have to break it into 3 parts, they have clarified and provided guidance on intensity-based calculations, uh, for example, which are based on productivity and population-adjusted incentives. Regarding spend-based emissions and estimations, they have introduced reliable spend-based estimation methods for Scope 1 and Scope 2 emissions. They have also addressed the data challenges by providing specific industry proxies. Moving on to the key SEBI decisions. In the last quarter again, SEBI approved certain changes to the LODR norms. We thought we'll just highlight the key items. Critical SEBI decisions would include uh, decisions relating to sustainability reporting. We know that under the SEBI norms, the certain entities are required to obtain an assurance of the BRSR core. Generally, this assurance is provided by a third party professional. What SEBI observed that the term assessment is very closely uh, aligned with an audit type services or audit professionals. So they have tried to change this notion. They believe that instead of assurance, it would be appropriate to provide an assessment. So they believe that the term assessment would be very similar to the impact assessment prescribed under the social stock exchange regime. They have again requested the Industry Standards Forum to provide necessary guidance or the standards on the manner of providing assessment on BRSR core. What we also like to highlight that SEBI has decided that this change applies from the current financial year itself, that is financial year 2024 and 25. Moving on to the other sustainability related changes, SEBI has felt that the value chain partners definition should be further eased. Uh, at present, the cumulatively 75% of entities purchase and sales by value should be comprising of value chain partners. Now, what SEBI has decided that value chain partners would be those who individually comprise more than or equal to 2% of the entity's value of purchases and sales. Regarding value chain disclosures, entities uh, have an option to limit the value chain disclosures by 75% of value of purchases and sales. Regarding ESG disclosures of value chain, earlier it was prescribed on a comply or explain basis. Now they have been made voluntary. They have also stated that the disclosure of previous year's numbers, as far as the ESG disclosures are concerned, they are voluntary in the first year. Moving on to disclosure of green credits. Under the BRSR core, leadership indicators are anyway voluntary. Now, they have said that under these indicators, the entity may decide to include disclosures relating to green credits, which include the green credits generated and procured by the entity or top 10 value chain partners. Moving to the last slide, SEBI has also decided to uh, ease the corporate governance norms for high debt listed entities. They have eased the qualifying criteria. Earlier, entities having 500 crores or as a monetary threshold were qualifying as high value debt listed entities. Now, SEBI has decided to increase the threshold from 500 crores to 1000 crores. They have also prescribed a separate chapter for the corporate governance norms for high value debt listed entities. They have also provided certain relaxations. For example, the high value debt listed entities, uh, they have an option to constitute committees of nomination and remuneration committee, risk management committee, stakeholders committee. As we know, as far as the equity listed companies are concerned, they are mandatory, but SEBI in its wisdom has decided to provide an option for constitution of these committees. As far as RPT transactions are concerned, SEBI has decided that material related party transaction approval by way of NOC from debenture trustees uh, can be obtained before obtaining shareholders approval, where shareholding is wholly or substantially held by one or few related party shareholders, and if the NOC is withheld, the same should not be forwarded to shareholders for their consideration. As far as computation of ceiling is concerned, they have said that the directorships in high value debt listed entities would be included while counting the ceiling on the number of directors, memberships, and chairpersons. Regarding BRSR reporting, they have decided to make this disclosure voluntary. Well, that's all we had to cover. Thank you, everyone. Hope hope you find this episode interesting. Thank you.